In 2011, the market was down all of 1.1% without dividends reinvested. If you had dividends reinvested, it basically broke even. It was in the green a little bit. That was in 2011. Do you remember 2011? Do you look in hindsight and say, yeah, that wasn't a very bad deal? Do you say, I survived that? Well, what happened in the year, intra-year of 2011? That's a whole different ballgame. And that's what we're going to talk about here today, my friends, at the Heritage Wealth Planning YouTube channel. So don't forget to subscribe down below and give me thumbs up. And of course, comments always help as well with a YouTube algorithm. So let's think about this. So in hindsight, we look at the stock market and we say the S&P 500 has averaged, 10% a year going back to 1926, basically the modern era of investing. 2017, it was 19.42 was up. 2016, 19.54. 2015, it was down 0.73. This is without dividends, just using price to price. 2011, like I just said, was down a little bit. 2012 was up 13.29, and you get the gist. 2005 is up 3%. 2004, 8.99. So you get the gist of this. So basically, we've had since other than 2008, we haven't had any significant decline almost for 20 years. So from 2002, it was down 23.37. But other than 2008, we've only had basically 2 down years if you're not reinvesting dividends. And those down years are minimal. But that's not true. 2011 is a perfect example of this, and I'll share with you here today. All right, so in 2011, again, we're just using point to point, price to price, without reinvesting dividends. We're not reinvesting dividends. The same methodology will be the same thing if you did reinvest dividends, but I wanted to share a point with you in terms of the prices that you'll see on the market index, if you will. We're going to use a S&P 500 index from Vanguard, VFINX, and I think that's the largest fund out there. And we're going to say, okay, so you're just an average investor. You're like, man, I survived the 2008 crash. Here I am. I made pretty good money in 2009, 10, and here it is in 2011. And I start the year at 117.13 is what your portfolio value, with the price per share of VFINX. So you're sitting there, okay, good. I'm glad I got back in it because I'm making money again. 2009 and 10 are pretty good years. So from the beginning of 2011, the first trading day, until about the end of April, early May, the market went from 117 to 120. That's a 5, 125.72. So in 2009, you're up good. 2010, you're up good. And starting 2011, you're up good as well. You're up 7.3% because, again, from price to price, 117 to 125. And you're like, yeah, this is good. Obama. You're like, yeah. But then, kaboom. From basically the middle of April, the end of April to October, essentially, the market took a 19.48% dump. There's no other way around that. It fell like a brick in water, almost 20%, which would put us in a bear market. Didn't quite hit there, but it came pretty doggone close. What were you doing during that time? Were you just saying, whatever, no big deal? Or are you sitting there thinking, oh, now it's coming because Bernanke, the days of quantitative easing, of easy money supply, of helicopter Ben, Obama, now I don't like him anymore. He overpromised, underdelivered. That healthcare bill, whatever it was, the Dubai debt crisis was in 2010. Maybe that was 2000, I can't remember. But it was always something happening for you to get all consternated and say, I can't take this anymore. I'm getting out of the market. And I'm telling you, I remember, I've told the story a million times. There's a friend of mine, West Point grad, and I were driving to do a presentation at West Point. It is in August of 2011. And I'll never forget this. So we're moving, because we did presentations all up and down the East Coast. I don't think we ever hit Bangor, Maine. I think we hit Portland, Maine, south. And so I think we're just doing, in this case, we started in Buffalo, went to Rochester, Syracuse. I don't think we hit Syracuse. Yeah, we did hit Syracuse. Anyway, we went through the upper stage of New York, going down to West Point, where we're going to end up our this month's tour of seminars. And I'll never forget, this guy called me, one of my clients at USA. So USA assigns you a bunch of clients, and nice guy. But he called me freaking out, and I'll just never forget. My cell phone coverage, this back in 2011, was pretty poor. And I remember he's like, I gotta sell. I was like, dude, I'm in the car. I can't do anything for you. And it's his money. I was just, they just assigned you a financial advisor at USAA. And I said, all right, well, if you're gonna do that, just call over the 800 number and they'll take care of it for you. But I said, I can't do anything for you. I'm literally in the car, probably going over the Tappan Zee Bridge or something like that. I don't remember. But I just remember just hearing this guy's freaking out because the market was down at that point, 15, 20% or something like that. And I'll never forget that because this guy was like, I think he was a flag officer, like a general in the Army. He had gotten out, but he wasn't. He wasn't a shrinking violet, a nervous Nelly. This guy was a flag officer, served many combat tours, and yet here he was, and he couldn't take it. And I said, okay, because he thought now, essentially the previous 2 years were what we call dead cat bounce. That it bounces up, even though the market as a whole was going down, and this time it's doomed. I should have put it on here, but don't forget, at this stage, gold was still kicking butt and taking names too, my friends. Gold had yet to lose its luster, and the USAA Gold Fund was literally the best performing fund for the previous 10 years, according to Morningstar. There's no better fund over the first part of the 2000 first decade in the new millennium than the USAA Gold Fund. And so just like a lot of people say, this is it, it's over. We had a nice little dead cat bounce, but I'm getting out. And Frank, I can't remember what he did. Hopefully he didn't get out. I just don't recall. Maybe I never talked to him again. Because again, they just assign you somebody. If he calls me, you answer the call, but you don't do anything. You just tell him this is what you think you should do, and blah blah blah. But it's up to him to do the rest. So I don't think he ever called me back. But I just remember he's a flag officer, has served multiple tours in Iraq in various combat zones, maybe in Vietnam. I can't remember. But I said, look, this happens all the time. If you're going to be invested in the market, you got to deal with the volatility. But he was assured that this was it. And so I presumably got out. I don't know. And hopefully he didn't get out and buy gold because the gold fund proceeded to anyway, so let's just say he sold at 101. So he locked in this 19.48% loss from 125 to 101. But then next, until the end of the year, from October until 31 December, the market went back up 14%. All right, so at the end of the day, the market was basically, if he didn't reinvest dividends, is down all of 1%. And I'm sure you sit there, I can take a 1% decline. I guarantee many of you are saying that right now. In fact, if you did reinvest dividends, you actually squeaked out a gain. Not much, but you did squeak out a gain. But I'm sure in hindsight, you're sitting there thinking, oh, 1% decline, that's no big deal. But within the market, it went from 117 to 125, which is up 7.31%. And it went from 125 to 101, which is down 19%. And then it went from 101 to 115, which is up 14%. That's volatility. But yet, ironically, no one thinks about it like that anymore. They say, oh, that was no big deal. That was an easy year, a slow year, no big deal, not a lot of volatility. When are we going to get back to normal volatility, or what? That's because normal volatility is much more volatile than a 1% increase or 1% loss in the market. And yet that's what happened in 2011. If you look at 2015, I'm telling you, the market did the same. I don't know about the exact circumstances of 2015, but I remember small caps in 2015 also, they got hammered. Small caps and international stocks got hammered in 2015. They were in a full-fledged bear, retreating into deep Siberia hibernation. And yet, you don't think about it, do you? Because in 2015, at the end of the year, from point to point, it just wasn't that big of a deal. And that's the issue that we're contending with here. I'm telling you, the JP Morgan study, every year from top to bottom within the market, intra-year declines, it's a 14% on average. And here is actually bigger than 14%, it's 19%. But every single year, positive, negative, it doesn't matter. From the top to the bottom, there's significant intraday declines or intra-year declines. And yet we look in hindsight and say, 2005, no big deal. 2009, yeah, I'm glad I stayed in the market because we made money. It wasn't like that from the beginning of 2009 until March 9th. I'm just telling you. And maybe I'll do another video on how volatile it was then too, and to see if you had the capacity to stay in there. Even though it looked like 2009 was a good year, the first quarter was horrible. People, me myself included, were freaking out. Oh my goodness, Obama just took over and he's a socialist and he's going to go Venezuela on us and blah, blah, blah. And it turned out not to be true. And as I always say, it turned out Barney Frank saved capitalism. And people say, Barney Frank. I'm telling you, it's true. Mark-to-market accounting. Mark-to-market accounting. So the point about this, why kill yourself? I mean, why sitting there in the market if you can't take it? It doesn't make sense. Don't bother with it. I don't get it. Don't look at the hindsight. Now, you can't see what I'm looking at, but you can see the record of the market. Say that doesn't look so bad. That gives me 10% a year. I got hit a couple of years where I made a little bit of money, lost a little bit of money. I can handle that. Can you? I mean, because if you're freaking out right now after we've had this thing serious run up from this point to right now to the end of basically October of 2018, we've had nothing but happy days are here. And now we have a little bit of a sell-off. We're down 15% and people are freaking out. I mean, this happens all the time. Why do that to yourself? Either recognize it's going to happen and say, I don't care, I'm staying the course, or don't bother. But don't say, the market was down 1.1%, I can deal with those kind of losses. But you miss out what really happened and the major losses within the year. I just don't do it to yourself, my friends. If you can't handle, it's nothing. You're not a bad person if you don't handle the markets. In fact, if anything, now is even better to get out of the market if you're losing sleep, because the CD rates are much higher than they were back in 2011. They just are, because the interest rates have gone up. So do yourself a favor. Relax. Recognize this happens all the time. When you're in a bear market, you don't know when it's going to end. It might never end. You just don't know. But it happens all the time. Do yourself a favor. Say, I'm in it for the long haul or I'm not. Don't go half throttle in there. Just either one or the other, and you'll be a happier person, I'm telling you. All right. As always, you like what you see here, don't forget to subscribe down below. Thumbs up. If you buy goods through my link on Amazon, you help this guy right here. I get paid big bucks, big bucks. But if you do find stuff that you want to buy on Amazon, if you do it through the link I put in the show notes, I appreciate that. And of course, always, you can go to Amazon and buy my books. And I get paid big bucks there too. Oh, yeah. No, we'll see you next time. Thanks, guys.